Today for the SIE exam, we will cover calculating the maximum gain, maximum loss, and break-even point for options contracts. Understanding these foundational calculations is critical, as they appear frequently in questions about suitability and strategy. Let's start with the buyer, who is establishing a long position. Imagine an investor is bullish on company ABC, which is currently trading at $52 per share. They decide to buy one ABC $50 call option for a premium of $3. To find the maximum gain, we have to remember that a stock's price can theoretically rise to infinity. Therefore, the maximum gain on a long call is unlimited. The investor's maximum loss is much simpler. No matter how far the stock price falls, the most they can ever lose is the initial investment, or the $300 premium they paid for the contract. For the break-even point, the stock price must increase enough to cover the cost of the premium. The formula is the strike price plus the premium. Here, $50 plus $3 equals a break-even of $53 per share. Now consider a bearish investor who buys one XYZ $40 put option for a premium of $2. The maximum gain occurs if the stock goes to zero. The gain would be the strike price of $40 minus the $2 premium, resulting in a $38 per share profit, or $3,800 for the contract. The maximum loss, just like with a long call, is limited to the premium paid, which is $200 in this case. The break-even is found by taking the strike price and subtracting the premium. $40 minus $2 gives us a break-even point of $38 per share. A great way to remember the break-even formulas is the phrase, call up, put down. For call options, you always add the premium to the strike price to find the break-even. For put options, you always subtract the premium from the strike price. This simple mnemonic works for both long and short positions. Now let's look at the seller, or writer, of an option. Selling options generates income from the premium received. If an investor sells one ABC $50 call for a $3 premium without owning the underlying stock, this is called a short uncovered or naked call. Their maximum gain is limited to the $300 premium they received. This is achieved if the option expires worthless. However, the risk is the most important concept to grasp here. The seller's maximum loss is unlimited. If the stock price skyrockets, the seller is obligated to buy shares at the high market price to sell them at the $50 strike price, creating uncapped risk. This is a favorite topic for exam questions, which often test your understanding of this unlimited loss potential. Finally, let's look at a short put. An investor sells one XYZ $40 put for a $2 premium. Their maximum gain is the $200 in premium received if the stock stays above $40. The maximum loss is substantial but not unlimited. It occurs if the stock falls to zero. The seller is obligated to buy the stock at $40, so their loss is the strike price minus the premium received, which is $38 per share, or $3,800 per contract. A common trap on the exam is forgetting to multiply the per share value by 100 to get the total dollar amount for the contract. Always double-check what the question is asking for, whether it is the per share break-even or the total contract loss or gain.